Texas Pacific Land Corporation, the Permian Basin Royalty Company, holding nearly 880,000 acres across West Texas, earning royalties on every barrel produced without drilling a single well.
FY 2025 revenue $798 million at 77% operating margin, with a first-ever data center land deal that opens a third revenue stream from AI infrastructure monetization.
The Texas and Pacific Railway received massive land grants in 1871. The railroad went bankrupt in 1888, and Texas Pacific Land Trust was formed, holding the acreage ever since.
NYSE listed since 1927, TPL generated royalties for over a century before launching Texas Pacific Water Resources in 2017, providing brackish water and produced water services for Permian fracking operators.
In 2021, the trust structure became a modern corporation. Q1 2026 brought the first data center land sale, $42.5 million, to a power developer building AI infrastructure.
Oil and gas royalties generate 65% of revenue, pure landowner income from hundreds of Permian operators with no drilling costs and no capital at risk.
Texas Pacific Water Resources contributes 35% of revenue, brackish water sourcing, produced water disposal, and recycling for fracking operators across 20 West Texas counties.
FY 2025 revenue grew 18% to $798 million at 77% margins. Free cash flow exceeded 57%. TPL's 111 employees make it one of the most capital-light businesses in the Permian.
Q1 2026, revenue $237 million, up 21%. EPS 207 beat the 195 estimate by 6%. Adjusted EBITDA was $181 million at 77% margin.
Viper Energy and Sitio Royalties are pure Permian royalty peers, fast-growing with strong EBITDA margins, but without TPL's water business, land portfolio, or data center optionality.
Blackstone Minerals and Permian Basin Royalty Trust offer broad mineral exposure, but smaller Permian concentration. TPL's scale, 880,000 contiguous Permian acres, is structurally unrepeatable.
TPL's moat is its land, a one-of-a-kind portfolio spanning the most productive oil basin on Earth, augmented by the only West Texas water business and AI data center proximity.
TPL holds approximately 880,000 acres across 20 West Texas counties, concentrated in the Delaware and Midland subbasins of the Permian, where well productivity per acre is the highest in the world.
The $42.5 million data center land deal includes a water supply agreement. AI data centers require both flat land and water in West Texas, two things TPL uniquely controls at scale.
Tyler Glover joined Texas Pacific Land in 2011, a Midland native who started as a landman and became CEO at 32 in November 2016.
Glover holds a BS from Tarleton State University and previously worked in mineral rights at Devon Energy. He serves as CEO of Texas Pacific Water Resources, overseeing both businesses.
Texas Pacific Land. The Permian Basin Royalty Company, $798 million in FY 2025 revenue at 77% operating margin, holding 880,000 acres across West Texas with water services and a first-mover data center land strategy.
Q1 2026, revenue $237 million, up 21%. EPS 207 beat the 195 estimate. A $42.5 million land sale to a data center power developer marks TPL's entry into AI infrastructure monetization.
Welcome to Charged Alpha. I'm Hudson. Tonight, Texas Pacific Land, TPL, Q1 2026. This company owns 880,000 acres in the Permian Basin and has never drilled a single well. Lana, they just hit a record quarter.
Record revenue, record net income, record free cash flow, all in the same quarter, Hudson. And now a pivot into data centers and desalination. Texas Pacific Land is not your typical energy company, and tonight's numbers prove exactly that.
Texas Pacific Land was founded in 1888. Originally a land trust holding West Texas real estate after a railroad defaulted on its bonds. It converted to a C Corp in 2021 and today owns roughly 880,000 surface acres in the Permian Basin, the world's most productive oil region. TPL doesn't pump oil. E&P companies, Chevron, Coterra, dozens of others, pay TPL a royalty on every barrel produced beneath its land.
That royalty model has almost no variable costs, margins most companies can only dream about. TPL also sells water to drillers, handles produced water coming back out of wells, and charges easement fees for pipelines and power lines. About 120 employees run an asset worth tens of billions. Think of it as a toll road operator who also owns the land under every truck.
Now the Q1 2026 numbers. Total revenue, $236.8 million, a Q1 record and up 20.8% year over year. Land and resource management, royalties and easements generated $153.6 million. Water services contributed $83.3 million.
The royalty headline is volumes. Oil and gas production on TPL land averaged 37.5 thousand barrels of oil equivalent per day, up 20.6% from a year ago. TPL doesn't control how much operators drill, but Permian activity has been running hot, and every incremental barrel drops near pure margin to TPL's bottom line.
Water delivered its second-best volume quarter in company history. Both produced water royalties and water sales set near records. The standout item, a $42.5 million land sale to a power generation developer supporting a data center, plus a separate long-term water supply agreement for the same project. Emerging revenue streams are materializing.
Profitability, adjusted EBITDA of $181.4 million, a 76.6% margin. Operating margin was 77%, flat with last year. Net income, $142.9 million. EPS came in at $2.07 versus the street estimate of $2.03 a beat. Free cash flow hit $136.4 million, up 15% sequentially. Zero debt, $247 million in cash.
The board declared a 60-cent regular quarterly dividend. With this level of free cash flow relative to capital needs, the company has historically layered in special dividends as well, so the headline yield understates total cash return to shareholders in strong years.
The one asterisk, revenue missed analyst consensus of $238.6 million by less than 1%, and adjusted EBITDA came in below the $204 million estimate, partly due to water infrastructure costs in the quarter. The stock sold off 5% on earnings day. At 51 times earnings, even a fractional miss triggers a re-rating conversation.
Let me briefly cover the CEO. Tyler Glover has led Texas Pacific Land since 2016, first as a board appointee and later through the C Corp conversion. He spent his career in West Texas land management and has been the architect of TPL's transformation from a passive royalty trust into an active resource management company. Under Glover, the water business grew from minimal revenue to $80+ million per quarter, and the company is now exploring desalination and data center land plays.
Now let's talk about how Wall Street sees this stock, because the valuation debate around TPL is genuinely fascinating. The consensus is moderate buy. 8 analysts cover it, which is thin coverage for a $30 billion company. The average price target is around $452, implying about 8% upside from the current price near $420. KeyCorp has an overweight with a $639 target, calling it a multi-year compounding story. Wells Fargo is also overweight. Stifel sits at hold, arguing the premium is already baked in. The wide target spread tells you this stock is genuinely divisive.
The core debate is this: how do you value an asset that is effectively irreplaceable? TPL trades at roughly 50 times earnings and 31 times sales, multiples that would be absurd for almost any other energy company. The typical Permian E&P trades at 10 to 15 times earnings. But bulls argue the comparison is wrong. TPL is not an E&P. It is a permanent royalty on the world's most productive oil basin, combined with a growing water utility. You cannot build a competitor to Texas Pacific Land. There are no 880,000-acre parcels in the Permian sitting available for purchase at any price.
That scarcity argument gets even more interesting when you layer in the emerging business lines. Produced water desalination, the ability to treat the billions of gallons of salt water generated by Permian drilling into something clean enough for industrial or agricultural reuse, could be a massive market. TPL has a pilot program progressing toward commercial milestones. CEO Glover specifically called out closing in on significant milestones on the call. If desalination scales, it transforms a disposal cost for operators into a revenue stream for TPL, with no additional land required.
The data center angle is equally compelling. AI infrastructure requires land with power, water, and connectivity. The Permian Basin in West Texas has abundant land, is buildable, has water access, and TPL owns the land. The $42.5 million land sale this quarter came with a long-term water supply contract. Management indicated the pipeline of similar conversations is active. If data center land deals become recurring, TPL's addressable market expands meaningfully beyond oil royalties.
The bull case rests on three pillars. First, Permian Basin production volumes are structurally growing. The Energy Information Administration projects U.S. tight oil output to keep rising through the late 2020s, and TPL captures that growth passively with no capital deployment. Second, water is increasingly scarce in the American Southwest, and TPL sits on one of the region's largest controlled water positions. Third, optionality. Data centers, desalination, power infrastructure. Each is an emerging revenue source that carries premium valuation because it is not correlated with oil prices. A company that is 40% oil royalty, 30% water utility, and 30% infrastructure landlord is worth a dramatically different multiple than a pure-play driller.
Now the bear case, and it starts with oil price sensitivity. TPL's royalty revenues move directly with both volumes and commodity prices. If oil drops from $70 a barrel to $50, operators cut drilling activity on TPL land, and TPL's revenue follows. The royalty model removes capital risk, but it does not remove commodity price risk. A sustained downturn in oil, driven by OPEC overproduction, demand slowdown, or accelerated energy transition, would hammer the top line.
Second risk, concentration. Every dollar TPL earns comes from one basin in West Texas. A regulatory change affecting Permian drilling, stricter produced water disposal rules, seismic regulations limiting injection wells, or federal land use changes could impair multiple revenue streams simultaneously. Compare that to a diversified royalty company with exposure across multiple basins. TPL's strength and its risk are the same thing. It is entirely Permian dependent.
Third risk is the valuation itself. At 51 times earnings with a stock already down 18% year-to-date after last December's 3-for-1 split, any further compression in the multiple is painful. The split brought the share price from roughly $900 down to the $300 range, more accessible to retail investors. But the underlying valuation mathematics did not change. If growth decelerates or the data center and desalination catalysts take longer than expected, the premium multiple has nowhere to hide. There is no yield support at 57 basis points of dividend yield.
How does TPL compare to its royalty peers? Viper Energy, ticker VNOM, is the closest public analog, a Diamondback Energy subsidiary that owns Permian royalty interests. Viper yields roughly 5% against TPL's sub-1% yield, trades at a much lower multiple, and has explicit leverage to Diamondback drilling activity. For income-focused investors, Viper is the rational trade. Blackstone Minerals operates across multiple basins with higher diversification but lower quality acreage. The MLP structure of most royalty peers generates K-1 tax forms that institutional investors dislike. TPL's clean C-corp structure is actually a competitive advantage for institutional ownership, and that may partially explain the premium.
On options and insider activity, the TPL options market is structurally thin. With a relatively low float and concentrated institutional ownership, Horizon Kinetics has been one of the largest long-term holders. Open interest is limited relative to market cap. The put-call ratio heading into earnings was approximately 0.70, reflecting moderately bullish positioning. Post-earnings, elevated put activity emerged as traders hedged the revenue miss and data center timeline uncertainty through the next quarter.
Insider activity has seen 2 open market sales in the past 6 months, consistent with routine executive diversification under pre-planned 10b5-1 plans. There were 0 insider purchases in Q1 2026. The more meaningful signal is Horizon Kinetics, the asset manager that has been the intellectual champion of the TPL investment thesis for nearly a decade. Horizon has not publicly reduced its position. For TPL specifically, Horizon's continued conviction carries more signal weight than standard executive sales, given how deeply their thesis is tied to the Permian land scarcity argument.
Bottom line on TPL.
8 analysts average target 452 against a 420 price. The real upside case is desalination going commercial and data center deals becoming recurring. If either scales, this stock re-rates hard. Until then, extraordinary business, extraordinary price.
That's a wrap on Texas Pacific Land Q1 2026. If this was useful, subscribe and leave a review. It helps more investors find Charged Alpha. More earnings coverage all season. I'm Hudson, she's Lana. Thanks for listening. This content is for informational and educational purposes only. It is not financial advice. Consult a licensed financial advisor before making any investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.